The impact of China's real estate crash. Introduction. The collapse of China's real estate sector, prominently marked by the Evergrande Group's financial troubles, has triggered a significant crisis affecting not only the economy but also societal norms and cultural perceptions regarding homeownership. This report examines the timeline of events leading to the crisis, its multifaceted impacts, and how it reshapes the landscape for future generations. Timeline of events. 1. Pre-2021 background. The housing bubble in China began in the early 2000s, fueled by rapid urbanization and speculative investments. The Chinese government encouraged property purchases as a means of stimulating economic growth, leading to a widespread belief that real estate was a secure investment. 2. August 2021, Evergrande Group warned of a cash crunch, leading to a drastic drop in its stock value and the onset of defaults across the property sector. By December, Evergrande defaulted on an offshore bond, exposing systemic vulnerabilities within the housing market. 3. 2022, the crisis intensified, with other major developers including Country Garden and Kaisa Group facing defaults. Homebuyers began to boycott mortgage payments for unfinished properties, reflecting a profound loss of trust in the market. For August 2023, Evergrande filed for bankruptcy, revealing staggering losses exceeding $66 billion. Simultaneously, Country Garden reported significant financial losses and default risks, underscoring the pervasive challenges across the property sector. 5. January 2024, a Hong Kong court ordered Evergrande to liquidate, marking a failure in its attempts to restructure debts. The crisis continued to strain local governments, resulting in a 23% decline in land sale revenue. 6. January 2025, the situation remains unresolved, with government interventions including debt restructuring and financial support for developers ongoing. Key points of impact. 1. Cultural shift in homeownership. The perception of homeownership has drastically changed, particularly among younger generations. Data shows that homeownership among adults aged 25 to 34 dropped from over 70% in 2010 to about 50% by 2020. In major cities, 30% of young adults now prefer renting, compared to just 11% among older generations. This shift is attributed to soaring home prices and economic instability. 2. Economic ramifications. The International Monetary Fund (IMF) has projected a decline in China's economic growth, forecasting a dip to 4.5% in 2025 due to the ongoing real estate crisis. Local governments are experiencing significant financial strain as revenue from land sales has plummeted. 3. Systemic vulnerabilities. The real estate crash has unveiled deeper systemic issues within China's financial ecosystem, including an over-reliance on shadow banking and excessive levels of developer debt. Regulatory measures like the Three Red Lines policy introduced in 2020 to limit borrowing inadvertently precipitated defaults. 4. Impact on local economies. The decline in land sale revenues has severely impacted local government finances, which heavily depend on income from property sales. The revenue drop has forced local governments to reconsider their funding strategies and financial planning. 5. Investor confidence. The crisis has eroded investor confidence in China's real estate sector. Previously seen as a stable investment, real estate is now viewed as a high-risk gamble. This loss of faith is reflected in the plummeting stock prices of major developers and the increasing caution of investors. Differing perspectives from sources. Source 1 emphasizes the cultural shift away from homeownership, linking it to rising prices and economic uncertainty. Source 2 focuses on the broader economic implications, highlighting the impact on local government revenues and overall investor sentiment in China. Source 3 provides a detailed timeline and analysis of regulatory changes, illustrating the financial contagion among developers. Conclusion. The fallout from China's real estate crash is reshaping societal norms around homeownership, straining local economies, and exposing vulnerabilities within its financial system. The government faces the daunting task of restoring confidence while navigating the complexities of reforming the housing market to ensure social stability. If systemic changes do not occur, the younger generation may redefine their relationship with real estate, viewing it as a burden rather than a cornerstone of financial security. As the crisis persists, the implications for China's economy and its citizens will continue to evolve, necessitating a careful and strategic response from policymakers. The impact of China's real estate crash, particularly following the collapse of Evergrande Group in 2021, has been significant and complex, reshaping various aspects of the economy and society. Below are some counterintuitive insights derived from the evolving situation of the real estate sector in China. 1. Cultural shift against homeownership. It might seem logical to assume that a housing market crash would lead to increased homeownership opportunities. However, the opposite is occurring. Homeownership rates among younger Chinese adults have decreased dramatically from over 70% in 2010 to about 50% in 2020. This decline is primarily due to soaring property prices and a cultural shift where younger generations perceive homeownership less as a goal and more as a financial burden. This shift could alter societal norms around property ownership, which historically has been seen as a cornerstone of financial security in China. 2. Economic growth decline. Despite government support, one would expect that government interventions and financial support for developers would stabilize and promote economic growth. However, the International Monetary Fund (IMF) has projected a decline in China's growth rate due to the ongoing property crisis, with forecasts dropping to 4.5% for 2025. This suggests that the real estate sector's troubles are so deep that even substantial government measures are insufficient to restore confidence and drive growth. 3. Trust in real estate as a safe investment shattered. Traditionally, real estate in China has been viewed as a stable and safe investment avenue. However, the collapse of major developers, including Evergrande, has revealed significant systemic vulnerabilities in the market. Many potential buyers, particularly younger individuals, are now wary of investing in property which they once considered a secure path to wealth. This radical change in perception could have long-lasting effects on investment strategies and consumer behavior in China. For increased reliance on family wealth. While it might be expected that financial assistance from parents would empower younger generations to enter the housing market, the reality is that this reliance on familial wealth is creating a greater divide. A 2023 survey indicated that over 70% of first-time homebuyers depended on parental support for down payments, effectively locking out many young adults who lack such financial backing. This dynamic may exacerbate social inequality as homeownership becomes increasingly unattainable for individuals from lower-income families. 5. The government intervention versus market principles. The Chinese government's approach of intervening to stabilize the housing market contradicts the foundational economic principle that markets should self-correct. By implementing measures such as the 3 red lines policy to control developer borrowing, the government inadvertently accelerated defaults, revealing that regulation alone cannot rectify deep-seated issues within the housing sector. The ongoing crisis illustrates the tension between government intervention and market forces, suggesting that attempts to impose order may lead to further chaos. 6. Shadow banking impact. Many analysts might overlook the role of shadow banking in exacerbating the real estate crisis. The reliance of property developers on shadow banking for financing has led to a systemic risk that is now manifesting as defaults ripple through the economy. Shadow banks, which had previously been viewed as alternative sources of capital, are now facing significant pressure, exposing their interconnectedness with the formal banking sector and contributing to broader financial instability. 7. Potential for ghost cities to become livable. Initially, the development of ghost cities, vast urban developments with few inhabitants, was a symbol of speculative overreach and economic mismanagement. However, the collapse of the property sector might lead to a re-evaluation of these areas. With proper investments in infrastructure and urban planning, these cities could be transformed into livable spaces, challenging the narrative that they are merely failures of the past. 8. Investor confidence and recovery. Despite the evident turmoil in the real estate market, there are ongoing reports of optimism from certain sectors about a recovery. This contrasts sharply with the reality faced by many developers who are struggling to meet their obligations. The dichotomy between investor sentiment and the ground realities of the housing market illustrates a disconnect that could lead to further speculative bubbles if not addressed properly. In conclusion, the impact of China's real estate crash is multifaceted, revealing surprising trends and counterintuitive outcomes that challenge conventional economic wisdom. As the situation evolves, it will be critical to monitor not only the immediate financial implications but also the long-term cultural, social, and economic transformations that may emerge in response to this unprecedented crisis. The report on the impact of China's real estate crash highlights several critical points that are often overlooked. Below are some of the significant aspects that deserve more attention and the reasons for their significance. 1. Cultural shift in homeownership attitudes. The shift in attitudes towards homeownership among younger generations is a crucial but often underestimated aspect of the real estate crash. The report notes that homeownership among adults aged 25 to 34 fell from over 70% to about 50% between 2010 and 2020. This change is not merely a reflection of economic conditions, it signals a profound cultural transformation in China. Significance: this cultural shift indicates a broader societal re-evaluation of what constitutes wealth and stability. Traditionally, homeownership has been viewed as a cornerstone of financial security in China. As young adults increasingly see homes as burdens rather than assets, this could lead to a long-term change in investment patterns and consumer behavior. The implications for the economy could be far-reaching, as a generation that does not prioritize homeownership may invest their wealth in different sectors, potentially stunting the growth of the real estate market further. 2. Economic implications on local governments. The impact of the real estate crash on local government finances is another critical point that may not receive adequate attention. The report indicates a 23% drop in land sale revenue, which constituted a significant portion of local government income. Significance: local governments in China have historically relied heavily on land sales for revenue, which means the collapse of the real estate market threatens their financial stability and ability to fund public services. This could lead to a reduction in public investment, further exacerbating economic stagnation. Additionally, as local governments struggle financially, they may be unable to support infrastructure projects that are critical for economic growth, creating a vicious cycle of decline. 3. Systemic vulnerabilities and regulatory failures. The report discusses systemic vulnerabilities within China's financial ecosystem, particularly the reliance on shadow banking and high levels of developer debt. The introduction of the 3 red lines policy aimed at curbing excessive borrowing ultimately contributed to defaults rather than stabilizing the market. Significance: this reflects a deeper issue within China's regulatory framework. The inadequate response to the growing debt levels and the lack of effective oversight mechanisms not only led to the current crisis but could also set the stage for future financial instability. The failure to learn from these mistakes could result in repeated cycles of boom and bust, undermining investor confidence and economic growth. 4. Impact of Evergrande's collapse. Evergrande's collapse has been a focal point of the crisis. Yet the broader implications of this event are complex and often glossed over. The firm's staggering $300 billion debt and its ripple effects on the economy highlight the interconnectedness of financial institutions and real estate developers. Significance: Evergrande's downfall serves as a cautionary tale for other developers and investors, illustrating the risks associated with over-leverage and speculative investments. The fallout from Evergrande's bankruptcy has the potential to trigger a domino effect where the financial distress of one major player impacts others, leading to a broader financial crisis that could spill over into global markets. This interconnectedness necessitates a reassessment of risk management practices among investors and lenders. 5. Consumer trust and market recovery. The report outlines how the crisis has led to a loss of trust among consumers, particularly as homebuyers began boycotting mortgage payments for unfinished properties. This erosion of trust is a critical element that could hinder any potential recovery in the housing market. Significance: consumer confidence is essential for economic recovery, especially in sectors like real estate that rely heavily on consumer sentiment. If potential homebuyers remain skeptical about the stability of the market, it could lead to a prolonged downturn. The challenges of restoring this trust are compounded by the lack of governmental compensation for those who have suffered losses in the housing market, further alienating consumers. 6. Long-term economic forecasts. While the report mentions that the IMF has forecasted a dip in China's growth to 4.5% for 2025, the long-term economic implications of the real estate crash are often underestimated. Significance: a sustained slowdown in growth could have profound implications for China's role in the global economy. As the second-largest economy, any significant deceleration could lead to reduced demand for imports from other countries, affecting global supply chains and economic stability elsewhere. Moreover, lower growth rates could limit the government's ability to implement reforms and stimulate the economy, resulting in a stagnation that lasts for years. 7. Potential for systemic change. The ongoing crisis presents an opportunity for systemic change in how the real estate market and financial regulations are structured. The report emphasizes the need for meaningful price corrections and improved housing policies. Significance: this moment could be a pivotal turning point for China, where the government might choose to implement reforms that address the underlying issues within the housing market and broader economy. If changes are made effectively, this could lead to a more sustainable and balanced economic model in the long term. However, if reforms are superficial or poorly executed, the potential for future crises remains high. Conclusion: the impact of China's real estate crash extends beyond immediate financial losses. It encompasses cultural, economic, and regulatory dimensions that could reshape the country's future. Recognizing and addressing these often overlooked aspects will be crucial for policymakers as they navigate the complexities of recovery and reform. Understanding these dynamics is essential not only for China but for global markets interconnected with its economy. 1. Cultural shift in homeownership. A significant consequence of China's real estate crash is the cultural shift in attitudes toward homeownership, particularly among younger generations. The decline in homeownership rates from over 70% to about 50% among adults aged 25 to 34 from 2010 to 2020 highlights a growing trend of renting over buying. This shift is influenced by soaring property prices, economic instability, and a reassessment of real estate as a safe investment. The younger generation increasingly views homeownership as a burden rather than a cornerstone of financial security, suggesting a long-term change in societal norms regarding property ownership. 2. Economic implications and local government revenue. The real estate crisis has profound economic implications, particularly for local governments that rely heavily on land sale revenues, which dropped by 23% in 2024. The International Monetary Fund (IMF) has warned of significant declines in China's growth, projecting a dip to 4.5% for 2025. This reduction in revenue affects local governments' ability to fund infrastructure and public services, creating a cycle of economic strain that further impacts the real estate market. The reliance on property sales for fiscal health highlights systemic vulnerabilities within the Chinese economy. 3. Systemic financial vulnerabilities. The crisis has exposed deeper systemic issues within China's financial ecosystem, including excessive developer debt, reliance on shadow banking, and regulatory challenges. The Three Red Lines policy aimed to limit excessive borrowing, but its implementation led to widespread defaults, highlighting the fragility of the property sector. The cascading failures of major developers like Evergrande and Country Garden raise concerns about financial contagion across the economy, affecting investor confidence and increasing the risk of a broader economic downturn. 4. A government response and future outlook. the Chinese government's responses to the crisis, including debt restructuring and financial support for developers, reflect attempts to stabilize the real estate sector. However, the effectiveness of these measures remains in question. As the government grapples with restoring confidence while managing social stability, the potential for meaningful reforms in housing policy is critical. Without addressing the underlying issues of affordability and systemic risk, the relationship between the younger generation and real estate may continue to evolve away from ownership, leading to long-lasting implications for China's economic and social landscape. 1. The 2008 subprime mortgage crisis. United States. The collapse of the U.S. housing market in 2008, triggered by high-risk lending practices and an explosion of mortgage-backed securities, had devastating effects on the global economy. Thousands of homeowners faced foreclosure and major financial institutions failed or were bailed out, leading to widespread economic recession. This crisis exposed systemic weaknesses in financial regulations and resulted in significant changes to housing policies and banking regulations in the United States. 2. The Japanese asset price bubble. 1986 to 1991, Japan experienced a significant real estate and stock market bubble during the late 1980s, characterized by rapid increases in asset prices fueled by speculative investments and easy credit. When the bubble burst in 1991, it led to a prolonged economic stagnation known as the lost decade. The aftermath included a banking crisis due to non-performing loans and a significant drop in property values, fundamentally altering the Japanese economy and real estate market. 3. The Asian financial crisis. 1997, originating in Thailand, this crisis spread throughout East Asia, leading to severe currency devaluations and economic downturns in several countries including Indonesia, South Korea, and Malaysia. A significant factor was the over-leveraging of real estate investments, which became unsustainable when foreign capital fled rapidly. The crisis resulted in widespread bankruptcies, loss of savings, and economic reforms aimed at stabilizing financial systems and restoring investor confidence in the region. Future outlook: predictions for the impact of China's real estate crash. The ongoing real estate crisis in China, catalyzed by the collapse of major developers like Evergrande, is likely to have lasting implications for the country's economy, social fabric, and housing policies. As we look toward the future, several key trends and potential outcomes can be anticipated. 1. Continued economic slowdown. China's economy, already forecasted to grow at a sluggish pace of around 4.5% in 2025, may experience further deceleration due to the ongoing fallout from the real estate crisis. The International Monetary Fund (IMF) has indicated that the property sector, which accounted for a significant portion of GDP growth, will struggle to rebound as long as consumer confidence remains low and household debt levels rise. Consequently, a protracted economic slowdown could ensue, leading to increased unemployment rates and decreased domestic consumption. 2. Cultural shift in homeownership. The cultural perception of homeownership in China is undergoing a significant transformation, particularly among younger generations. As homeownership rates among adults aged 25 to 34 have plummeted from over 70% to around 50% between 2010 and 2020. This trend is expected to continue. Young adults are increasingly viewing real estate as a burden rather than a cornerstone of financial security. If housing prices remain high while wages stagnate, we may see a cultural shift where renting becomes the norm, leading to a more mobile workforce and altering the traditional family structure. 3. Regulatory and policy changes. The Chinese government will likely implement further regulatory reforms in response to the crisis. These could include introduction of property taxes. The potential introduction of property taxes aims to curb speculation and stabilize the market, though resistance within the Communist Party could delay this initiative. Increased support for affordable housing. Local governments may ramp up efforts to provide affordable housing solutions, shifting focus from speculative developments to public housing projects to regain consumer trust. 4. Financial sector adjustments. The crisis has exposed vulnerabilities within China's financial system. particularly in shadow banking and the reliance on real estate as collateral for loans. Future adjustments might involve stricter regulations on lending practices, particularly for property developers, to prevent a recurrence of the crisis. This could lead to a tightening of credit availability, impacting small businesses and consumers reliant on loans. 5. Increased investment in alternative assets. Given the volatility in the real estate sector, investors may begin to diversify their portfolios away from property and towards alternative investments. This shift could foster growth in sectors like technology, renewable energy, and healthcare, which may be viewed as more stable and promising in the long term. Moreover, foreign investment might become more cautious with a focus on industries perceived as less risky than real estate. 6. Social unrest and public sentiment. As the crisis unfolds, social unrest could become more pronounced, particularly among those who have invested their savings into properties that remain unfinished or unsold. Public sentiment could turn against the government if it fails to mitigate the effects of the crisis, leading to protests and demands for accountability and reform in the real estate sector. The government's ability to maintain social stability will be crucial in navigating the fallout. 7. Global economic implications. The repercussions of China's real estate crash are likely to extend beyond its borders. Global markets could experience volatility as investors reassess their exposure to Chinese assets. Additionally, a slowdown in China's economy may impact global supply chains and trade dynamics, particularly with countries heavily reliant on exports to China. This could lead to shifts in global economic alliances and trade partnerships. 8. Potential for consolidation in the real estate sector. As weaker developers succumb to financial pressures, there may be a wave of consolidation within the real estate market. Larger, more stable developers could acquire distressed assets at discounted prices, potentially leading to more streamlined operations and a focus on quality projects. This consolidation may result in a more resilient real estate sector in the long term, but it could also stifle competition and innovation. Conclusion. The impact of China's real estate crash is multifaceted, with significant implications for the economy, society, and the housing market. As the situation continues to evolve, it will require careful navigation by policymakers to restore confidence and stability. While the immediate future may be fraught with challenges, the potential for transformative change in housing policy, investment strategies, and cultural attitudes toward homeownership could redefine the landscape of China's real estate sector for years to come. Without substantial reforms, however, the younger generation may continue to view real estate as a burden rather than an asset, reshaping the future of housing in China.